All right, it's July 2nd. Welcome to the Mortgage Insider Call. I'm Daniel Jackson. Today, I have a few interesting topics to go over, some things that have been coming up a lot lately, and hopefully, this is stuff that will be able to give you a little more understanding of how the financing side of real estate works and give you a little more info and ability to negotiate deals with clients. We're going to talk a lot about mortgage rates, and this is a discussion that I've had with clients quite a bit recently on why the differences in interest rates, why one person's rate is different from another, why it fluctuates on programs. And I think it's a really important question. And part of the problem of why people don't understand it is because a lot of mortgage lenders don't talk about it. So I'm going to just show you behind the curtain of what it looks like for mortgage lenders, all the things that go into a rate quote, and hopefully that will help you to understand and get the best deal on your next mortgage or help to negotiate for your clients. So we're going to talk about mortgage rate fluctuations. Another thing that has happened lately is having houses either appraised low in some cases or people having to bid over the asking price. So this has been coming up where the good houses tend to go really quickly. And so you'll find a house that comes on the market, you really like it. Well, everybody else has been looking for a good one too, and you end up having a little bidding war. So it's a very interesting real estate market right now where somehow some neighborhoods are going up, some are going down. And overall, you get this kind of weird dynamic of some houses sitting on the market for a while and not selling, and then other ones just coming up and immediately going into a bidding war. And so I just want to show you the impact of that and how you can keep the deals together. Sometimes if you have to overpay for the house or if the appraisal comes in low, there's some different strategies that we can do. So let's just jump into interest rates. And the question I like to ask clients is, what do you understand about mortgage rates and how they fluctuate? And um, you hear a lot on the news, oh, hey, mortgage rates went up or mortgage rates went down. And it's like, compared to what? And so, what I like to show people is this is the Freddie Mac primary mortgage market survey. They come out with the interest rate every Thursday. So, it's a once a week reporting on what the average rates were the week before. So, you can see currently, this is as of last week, because today's Wednesday, so it doesn't come out again until tomorrow. But last week, the 30-year fixed rate average was 6.77. The 15-year was a little bit lower at 5.89. And so that's where we're at. You can see that for this year, it's kind of been hovering under the 7% range. And so rates are still kind of up there. We could zoom out a little bit more, but um, we don't need to get into it too much. But rates have been kind of up and down. What a lot of people don't realize is that mortgage rates actually are based on the mortgage-backed security market, which is the bond market, and it trades just like the stock market. It's up and down throughout the day. And so sometimes on any given day, we might see two or three reprices. Sometimes rates will get worse and then better, or worse and then worse again. And that can happen throughout the day. And so mortgage rates are really a moving target, sometimes super volatile. This is what it looks like. This is just a snapshot from earlier this morning, where you can see, and on this chart, this is the bond market chart. So if the candlesticks here are higher, then that means rates are lower. So you could see we're in a pretty good spot right now. Rates are lower than they have been for most of the year this year, and they're actually improving a little bit. Um, the other thing, so that's the first thing that factors into the rate quote is just what's going on in the market, what's the bond market doing, and just the health of the economy overall really factors into it. The second thing that factors into it, and this is public information, but most people don't know this, is that these are published charts. You can just Google Fannie Mae LLPA. See, it says it here, which is just basically they're saying these are the adjustments that we make to rates based on the terms of the deal. The biggest ones, and there's 30 something factors that go into a rate quote, but the biggest ones are pretty much your down payment and what your credit score is. So you can see I highlighted on here. So say you have a 720 credit score and you're putting 20% down, that would mean your loan to value range would be 80%. Then this 1.25 is an adjustment to, it's basically the discount points, it's the closing cost. So if it's at zero, so say you put 40% down, then you're going to have zero adjustments. And if you put 20% down, it's going to be 1.25. That means for the same interest rate that somebody putting 40% down would get without having to pay any closing costs, you'd have to pay 1.25% of your loan amount in additional closing costs or discount points. So the crazy thing is, look at this chart. If you keep going over to the right, somebody putting less than 5% down. So a first time buyer can do it with 3% down. So it's only 0.75. So they actually get a 0.5% better pricing than you do with 20% down. So it doesn't always make sense. The other two big ones are investment properties and second homes. You can see there's a bunch of other ones here, property types, manufactured, 2 to 4 units, um, all those kind of things. But say you're buying an investment property and you're putting 20% down, that adjustment is 3.375 on top of whatever the credit score adjustment is going to be. And so you can see that adds up really quickly. And so some people will say, well, you should put 25% down on a investment property instead of 20. The reason for that is look how much better it gets. You save 1.25% in loan fees by doing that. And then if you put 30% down, it drops even more. 40% down, it drops even more. It's just kind of a trade-off. You have to decide if it's worth it or not. Second home, same thing, big hits. I mean, if you do a second home and you're putting 20% down, you're going to have the exact same pricing as you would on an investment property. So it's going to be ugly. It's going to be a high interest rate. Just something to keep in mind. The other one is, let's say a refinance. Here's one I was looking at the other day, a refinance on a cash out. So if you're taking cash out on a refi, depending on your credit score, you're going to see there's going to be some big adjustments for that too. You can go up to 80%. So if you're going to take money out of your house and refinance your mortgage, you could take out up to 80% on a conventional loan. But look what happens if you have say you have a 699 credit score and you're taking out 80%, that adjustment's 3.75. So you're going to pay pretty much the same rates as somebody who was buying an investment property. So that's where if the house appraised for enough, you might consider maybe only taking out 70% instead of 80. You'll get less cash, but you'll qualify for a lower interest rate. The other thing that helps is raising your credit score. So you could see here, if you went from a 699 up to a, say, a 720 or 725, something like that, then you would save 1% of your loan amount off the loan fees on that same cash out refinance. So the credit score matters big time. Now, with credit scores, everybody always asks, well, hey, I have Credit Karma and it says my score is 800 or 850. And then we'll pull it and we'll pull something completely different. So what do mortgage companies look at? Well, we have what's called the mortgage FICO. So first off, the scoring model that mortgage companies and banks and when you're getting car loans or whatever, we just use an older, outdated scoring model. Now, if you look on your Credit Karma, it's going to tell you TransUnion, or sometimes it'll probably say Vantage score, and banks just don't use the Vantage score yet. It's available, it's out there, it's an updated, more modern model for coming up with the credit score, but the banks don't trust it yet. And so they use kind of, I think we're using FICO version 8 or something from 2008. So it's an older version. The other thing is, which bureau do we use? Well, the answer is we have to pull all three credit bureaus, and then we're going to use whichever one comes in the middle. So in this person's case, like we have two borrowers. This is borrower one, this is borrower two. And so this guy has a 739, 746, 738. So we use the one that's in the middle, not the lowest, not the highest. So that middle score happens to be the TransUnion. So it's not that we always use TransUnion, it's just whichever one happens to be in the middle. And then the co-borrower was a 819, 818, 813. So that was the 818, which is the Experian. Kind of weird. But then when you have two borrowers, we have to take the middle score of whoever's is lowest. And so the mortgage FICO in this case would be 739, even though, the one client has a 818 and his highest score is 746, which would make a difference. Back to these charts, the 739 versus the 740 with 20% down, that's a 3/8%. That's a lot of money. It would make a difference. But anyway, that's what mortgage companies look at. And then one other thing to point out is that there's actually waivers on these adjustments in certain cases. So home ready loans would be let's skip that one. But first time buyers with qualifying income less than 100% of the area median income. So depending on where you are, we could look up the AMI number. And if you're below 100% and one of the borrowers is a first time buyer, then you would qualify for an LLPA waiver, meaning come back to this, you put say 5% down and say you have a 620 credit score, it would normally be a 1.75 hit to your rate. Um, that would be waived and it would go to zero if you qualified income wise. So that's something that lenders have to watch out for. A lot of times it's not built into their software and they have to manually put that in. So that's something that we're always on the hunt for. There's also some other instances where those are waived and you'll qualify for a better rate if you fit within certain buckets. So something else to check out with. All right. Now, once all that is said and done, so we take all the factors of the rate and we put them in, and then we're going to get a rate stack like this here on the left. So this board or this stack of rates here, notice that the interest rate is as low as 4.875. This isn't live, but this is from just a couple days ago in an actual scenario. So you could get a rate as low as 4.875 and all the way up in the sevens. Now, the difference is this column over here that says credit or cost. So to get the lower interest rate, you're going to pay a higher cost. And this is where there's a lot of deception in mortgage advertising because there's a ton of fine print. And a lot of times, if you're looking for rates online, you might see that 4.875 or something close to it, some of these lower rates. And then the fine print, you'll have to scroll way down and read some tiny paragraphs of fine print down at the bottom. And that's where you have to really be careful that you're getting an accurate quote. Well, when I'm dealing with clients, what we do is our policy is to give you full access to the rate board. So we plug in your scenario and you can choose whatever interest rate you want. Now, we try to help you make the best decision. We try to educate and empower you and run the numbers so that you are making a good, mathematically smart decision on the rate, but ultimately it's up to you on which one you want. So like here's just a little breakdown of a recent client that I was working with. 679 purchase price, 577 loan amount. And then this is how the interest rates impact. And so what I do is I try to choose 3 or 4 rates that I think make the most sense. And then we just run the math on how much is that going to cost you versus how much it's going to save you. And so like in this case, you go to this 7.125, you notice it's a half a point. So there's 3,041 of discount points that are included in there. So that's factored into this cash to close number. And then if you wanted to get a 6.99, then that goes up to 5177. So you notice the cash to close goes up. Now, all the interest rates are the same except for just those discount points. So we're just looking at, okay, if we take the next lower interest rate, it's going to save $52 off the monthly payment. It's going to cost about $2,200 more. And so does it make sense to do it or not? And then also 6.625, 5.9. Now you can see 5.99, 4%. Now you're paying $23,000 in loan fees, but it's also lowering your monthly payment by $431. So the break-even analysis looks like this, and it says, okay, right now I tend to run these for 2 years because I figure 24 months is probably the longest anybody's going to be in their loan. At some point, there's going to be a chance where the interest rates will be lower. You'll be able to refinance to a lower interest rate. So when that comes along, you're going to refinance. And so you're not going to be realizing the savings of the low interest rate on that loan for long enough for it to pay off. And so when you compare that 7.125 versus the 5.99, you actually come out $6,900 ahead by taking the higher interest rate. So I think this is really important to understand and to run the numbers on and make sure that you're making a financially wise decision that, okay, the 5.9 sounds like a much better rate than 7.125, but if you're strategically choosing the higher interest rate because you know it's going to save you more money over time, then that feels a lot different than saying, oh man, my interest rate's over 7%. I hope that makes sense. Okay, the other thing is the breakdown of closing costs. I just want to show you this. So, and this one, I'm just showing the 7.125, but we can show details of the closing costs of each one of those side by side, just so that you could compare the difference. But if you look at this, all the fees are going to be exactly the same except for the discount points. And so the only fee that Nova charges is a flat $13.95 for the processing fee. Now, a lot of lenders will charge points like origination fees of 1% of the loan amount and stuff like that. So our policy is just charge a flat $13.95. And then everything else is pretty much third-party fees. You have an appraisal fee that goes to the appraiser. You have title fees that go to the title company. You have a recording fee that goes to the county. And then you have prepaid items, which is like you pay your first year of your homeowner's insurance a year in advance at closing as part of your closing costs. That goes directly to the insurance company. And then you're going to have a few months of taxes and insurance also set aside to pay those bills when they come due as well. And so that's your money, but we're taking it up front to set it aside to pay the taxes and insurance next time they come due. All right, any questions about that? I don't see any questions in the chat or anything. I'm just going to keep powering on. Okay, so what happens if your appraisal comes in low or if you have to offer more than the house is currently being asked for? I think this is pretty much is the same. It's not going to feel the same, but the math is going to work out pretty much the same in either scenario. So I'll just share a recent example. And this is a bigger loan. This is a custom home. 1,225,670 is the sales price. And the appraisal actually came in $140,000 lower than the sales price. This happens a lot with custom homes because you put upgrades and you put fancy finishes in a home that aren't necessarily going to add dollar for dollar value to your appraisal. And then being Yuma, Arizona, there's not a ton of homes that are selling over $1 million. And so the appraisers have a limited pool of comparable sales that they can go off of to try to figure out what the house is worth. So the person obviously made all the decisions on what finishes and upgrades they wanted to put into the house. They were happy with the price. They agreed to it at 1,225,000. And so the fact that the appraiser says his opinion is that the house's value is lower at 1,085, it doesn't really affect the buyer's willingness to pay the full price for the house. They knew that there was a possibility of the appraisal coming in low. And so let me just walk you through this. Their initial plan was to put 20% down on the sales price, which is with closing costs ends up being about 268,000 out of pocket. Now, what happened is their lender said, well, now with the appraisal value, you have to put 20% down plus the additional difference between the appraised value and the sales price. So you're going to have to come up with that extra money. Well, not dollar for dollar, but you have to have 80% equity under the appraised value. And so the extra money above the appraised value that you're paying for the house, you have to pay in cash. So that essentially made them have to come up with an extra 110,000 or so. The way the math works out, now they need 372. So that's a big surprise at closing to all of a sudden need an extra 100 grand. Maybe they had it, maybe they don't. I don't know, but they didn't want to do it. So what we're able to do in this case, Nova has a special program, and I forgot to put the flyer in here, but it's a physician loan, but it also works for anybody with a 4-year degree. So we have a program where we can lend much higher loan amounts, and we can actually do up to 95%. And so with as much as they're putting down here, they could just keep their down payment exactly the same, keep the monthly payment, the interest rate, everything's exactly the same. And basically, we just don't care about the lower appraised value because they have enough equity in the house. This program also has no PMI. So, technically now they're at like 85 or 86% loan to value ratio. So you would need PMI. But on the physician loan, it doesn't require PMI. So we're able to keep them in the same exact loan amount, same exact down payment, monthly payment, interest rate, everything is what they were expecting, even though the house appraised low. So what does that do for you? Well, let me show you two different ways. Okay, here's the cynical way is, look, if the house appraised at 1.085, it's only worth 1.085 now. So you're actually paying 140,000 too much for the house. If that's the case, right now our forecast appreciation rate is 2 point something percent. So say the house keeps going up for the next couple of years at that 2.8% appreciation rate. I think it's actually much higher, but let's just, for argument's sake, we'll say it's going up about that 2%. It's going to take about 51 and a half months before you'll break even. So you'll be paying down your loan balance over that time. And then you'll also be having the house go up in value. So a little over 4 years from now, the house is going to be worth over that amount anyway. They're planning on staying in the house for much longer than that. And so that's, they're comfortable with that. If you stay in a house long enough, it's going to be worth more than what you paid for it. So eventually by year 5, it's going to be worth 1,246,606, which is more than the asking price now. So I call it the cynical way of looking at it, but that's kind of realistically, if you have to overpay for the house now, as long as it continues to appreciate, you're going to end up breaking even at some point. So as long as you're going to stay in the house for long enough to make that happen, then it's still a smart move. Now, the realistic route is that if they move forward with the purchase, What records is not the appraisal. What ends up recording is the sales price of the house. So once they close on this purchase, it's going to be public record that they paid 1,225,670 for the house. And so what does that do? Well, now the next appraiser who comes along to appraise the next similar house is going to be able to use that house as a comp, and they bought it for that price. So that becomes the value of the house. So realistically, even though this says, okay, you might be underwater for 4.5 years, realistically, as soon as you close on it for that, that becomes a comp for the appraisers, and that's the value of the house. I hope that makes sense to everybody. Okay, another scenario. Now that was being a loan amount's close to 1 million. It's over the conventional limit, and then you don't have PMI options that you would on conventional loans. But so here's another one where let's say 679 purchase price, they're putting 10% down. A lot of people don't know that even with less than 20% down, you have options with your PMI. The mortgage insurance that allows you to put less than 20% down is flexible on conventional loans. So here I'm showing you that with a 10% down payment, you could either pay the mortgage insurance as a monthly cost or you could pay it as an upfront cost. So look at this. The difference is what, about 6,000, 5,800 extra down, and then you have no monthly mortgage insurance. So it's 112 a month. So that's the trade-off in this case. So going with the monthly amount, it's $112.04. Or if you go with the upfront single premium, we call it single premium mortgage insurance, then it's 5805. So you can either pay it as a one-time 5805 or you could just pay the 112 a month. Now, if you just do the math, let's say I'm right about refinancing it in 2 years, then if you pay the 112 a month times 24, that's only $2,600 that you'd have to pay instead of 5,800 up front. So I think the monthly PMI is probably the smarter choice. But if you take 5805 divided by 112, it's 51 months. Very similar to that break even on the other one. So if you keep the house or keep the mortgage for a little over 4 years, you're going to break even either way. I guess the bottom line is that there's strategies, there's ways of putting things together, even if you have to pay a little more for the house than you think it's worth today, or if your appraisal comes in low and you're still willing to buy the house for the full amount, there's strategies for putting it together and keeping your deal together and getting you into the house or getting your clients into the house that you just have to think strategically a little bit, put a little bit of work into it. So thanks for coming today. I don't see any other questions or anything, so I'm just going to wrap up. But if I would love to work with you as an agent, I do my Monday mortgage rant email. So there will be a subscribe link down in the YouTube video. I'm putting it in the chat right now. You can just click the link and make sure you're getting my Monday emails. We do this webinars like this on the first Wednesday of every month. So I just try to share something that has been coming up recently, strategies, tactics, marketing ideas that are working in today's current market. And so my goal is to help you build your business, and then we can do Q&A and ask any questions and just kind of have a live Q&A with the lender if you want. If you want to co-market any listings, we have some great tools that we're doing with videos and drone shots and stuff like that, and doing things on social media. Also, HomeBot is a great tool for keeping in touch with your past clients. And so reach out to me about that, and I'd love to help you. All right. Thanks again, everybody, for coming, and we will see you all next time.